Welcome to today's deep dive. We are really thrilled to have you with us today.
Yeah, glad you're here. We've got a massive one today.
We do. We are setting out on a very specific high-stakes mission for this deep dive. We are unpacking what is, frankly, unequivocally shaping up to be the defining tech showdown of 2026.
All right, Meta versus Amazon.
Exactly. Meta versus Amazon. Both of these companies are allocating just astronomical amounts of capital toward artificial intelligence right now. We're talking about infrastructure spending that literally rivals the GDP of some nations.
It really does.
But the market is treating their investments very differently, and it's creating this, fascinating divergence in how these tech giants are actually being valued.
And to understand why that divergence is happening, we've pulled together a pretty heavy stack of sources for you today to parse through.
Yep.
We're looking at stock comparison data straight from Portfolio Slab, rigorous equity analysis from Morningstar, and some really sharp market commentary from investing.com, NAI 500, and LPL Financial.
Which is a lot to get through, but we want to frame why this specific debate matters to you, the listener, right now.
Right, because whether you're actively rebalancing a portfolio or looking for the right 2026 value play, or honestly just trying to wrap your head around the sheer scale of this AI arms race.
Which is dizzying.
It is. But understanding how these two giants are actually monetizing artificial intelligence, that's what will give you a distinct analytical edge here. It is no longer a conversation about who has the smartest chatbot.
No, not at all.
It's a fundamental question of business models, capital expenditure efficiency, and market perception of risk. The underlying business models basically dictate everything.
Right.
We're looking at two entirely different approaches to extracting value from the exact same technological leap.
Okay, let's unpack this. I want to start with the tail of the tape. Let's look at the raw fundamentals as of March 2026, just to establish the baseline scale we are dealing with.
Good place to start.
So Amazon is a $2.32 trillion enterprise. They are pulling in over $716 billion in trailing 12-month revenue.
Just massive numbers.
Massive. Now, Meta is significantly smaller by revenue. They're sitting at about $200.9 billion for the trailing 12 months. Yet, despite generating less than a third of Amazon's revenue, Meta boasts a $1.67 trillion market cap.
And what's fascinating there is how efficiently that revenue translates into actual profit. The margin story is what brings the structural divide between these two companies into really sharp focus.
Yeah, lay that out for us.
So Meta's gross margin is hovering at 81.8%.
Wow.
Right. Contrast that with Amazon's 48.5%. And when you look down the income statement at operating margins, the divergence is even more extreme. Meta's operating margin sits at 41.3%.
Which completely dwarfs Amazon's 11.7%.
Exactly.
But that structural divide, it makes sense when you consider the physical realities of their businesses, right? I mean, Amazon operates this sprawling, low-margin retail and logistics footprint.
Physical warehouses, delivery fleets.
Tons of physical inventory, whereas Meta is operating almost entirely in the realm of zero marginal cost digital real estate.
Yeah.
But looking at their forward PE, they are trading neck and neck. Amazon is hovering at 29.8, and Meta is right behind at 27.6. For companies with such vastly different margin profiles and physical footprints, that parity is really striking.
It is striking. And for you listening, that parity signals something crucial about how the market is weighing growth versus risk right now in 2026.
Right.
Because on paper, Meta offers higher revenue growth, vastly superior margins, and it trades at a slightly cheaper valuation than Amazon. But fundamentals primarily tell the story of the past and the present.
So to understand the future.
To understand the future and why they are trading at such similar multiples, we have to look at capital expenditures. CapEx is the roadmap for the next decade.
Here's where it gets really interesting. Let's dig into the $125 billion AI CapEx divide. This was highlighted brilliantly in our investing.com source. Both of these companies recently announced they're spending roughly $125 billion in capital expenditures.
Almost entirely earmarked for AI infrastructure.
Right. But the market reaction was a complete paradox. When Amazon announced its spend, the market rewarded them with an 11% stock surge.
Yep.
When Meta announced roughly the exact same infrastructure spend just hours earlier, investors initially punished the stock with a 12% collapse.
A massive swing.
We are looking at the same industry, the same AI narrative, but completely opposite outcomes. Why the double standard?
Well, the investing.com analysis attributes this to a concept called double monetization. This is the core thesis explaining that seemingly contradictory market reaction.
Walk us through that.
Okay, so when Amazon spends $1 on a state-of-the-art AI server, they have the architecture in place to monetize it twice. First, they sell that raw compute power to external enterprise customers through Amazon Web Services,
AWS.
right? AWS already carries 30% operating margins, so Amazon generates profitable revenue from that physical infrastructure almost immediately.
Okay, so that's the first monetization.
Exactly. But then they also utilize that exact same underlying infrastructure internally. They use it to optimize their retail logistics network and their fast-growing retail advertising business.
So essentially, Amazon is subsidizing its internal artificial intelligence R&D by renting out the excess compute to the rest of the Fortune 500.
That's exactly it.
Now, Meta is in a completely different boat. 98% of Meta's revenue comes from advertising. They do not operate a massive public cloud platform.
No AWS equivalent.
None at all. So when Meta buys a mountain of silicon, it is a pure internal cost. That expense absolutely must result in substantially better ad targeting to justify the outlay, or they have to invent entirely new product revenue streams.
They're absorbing 100% of the risk in-house.
Right.
If we connect this to the bigger picture, it comes down to how much of that forward-looking spending is covered by immediate, tangible revenue. Financial analysts track a metric for this called the CapEx coverage ratio.
And what does that look like for them?
For Amazon, their CapEx coverage ratio sits at 4.4x, meaning AWS revenue covers the depreciation of that AI hardware more than 4 times over.
Wait, so if Amazon is at 4.4x, where does Meta sit?
Meta's current external AI coverage ratio is 0. They do not sell compute.
Zero external coverage. They're spending $125 billion on infrastructure they can't rent out to anyone else.
Right.
It's like, if I can make an analogy here, it's like Amazon is a landlord who builds a mega mansion, lives in one wing, and rents out the rest of the rooms to pay the mortgage.
That's a great way to put it.
While Meta is building a custom mega mansion entirely for themselves and just hoping it makes them more productive at work so they can afford the payments, how is the market not punishing them even harder for that lack of a safety net?
Because the market recognizes the high-wire act Meta is performing, investors feel safer with Amazon's model because the floor is higher. Which really brings us to the specific case for Amazon as a 2026 investment.
Which is all about resilient durability.
Exactly. The data we have from NAI 500 outlines a very compelling multi-engine growth story, and it relies heavily on AWS proving that these AI investments are bearing fruit today.
Right, and looking at the NAI 500 data, Amazon's AWS division is actually re-accelerating. It's growing at 20% year over year, hitting $33 billion in the third quarter alone.
That is a staggering, absolute dollar amount of growth for a division of that size.
It really is.
And it shows we are moving past the theoretical phase of AI and seeing actual enterprise execution.
Like, what are they executing?
For example, Amazon deployed an AWS AI agent called Transform. This specific agent is designed to map legacy databases and rewrite old code to make it compatible with modern cloud infrastructure.
That sounds incredibly tedious for a human to do.
It is. Transform has reportedly saved AWS customers over 700,000 hours of manual migration work. Cloud migration has traditionally been a massive bottleneck for enterprise adoption because it requires intense human labor. By automating that friction, Amazon accelerates the rate at which companies move on to AWS, which locks in that long-term revenue.
And they're also building a serious moat on the hardware side too, right? We are seeing massive adoption of their in-house Trainium 2 AI chips, which grew 150% quarter over quarter.
Massive growth.
By designing their own silicon, Amazon is reducing its reliance on third-party vendors, which naturally protects their margins against hardware pricing monopolies.
That vertical integration is absolutely vital. And while the cloud division acts as the primary growth engine, Amazon's advertising business is quietly becoming a profit juggernaut of its own.
The ad revenue surged 24% to $17.7 billion.
Yeah. Retail media networks are incredibly lucrative because the ads are placed right at the point of purchase. When a consumer is searching for a product on Amazon, their buying intent is already exceptionally high.
Right. They are already there to buy.
Exactly. AI simply optimizes matching that specific search with the highest bidding relevant advertiser.
So when you synthesize all of those components, a re-accelerating cloud business, vertical integration in silicon, and a booming high-margin ad business housed within the retail site, Amazon represents a deeply diversified play.
It does.
If you are an investor looking for safety and predictability in 2026 amid a volatile macro environment, Amazon's ecosystem provides a structural durability that is very difficult to disrupt.
That safety factor with Amazon is undeniable. But if Amazon is the safe, self-funding play, we have to ask how Meta is justifying its own $125 billion spend without that AWS safety net.
Because they don't have it.
Right. Because looking at the Morningstar analysis, they are clearly transforming into something entirely different than the social media company they were just a few years ago.
I am looking at Morningstar's notes right here, and their equity analysts are surprisingly bullish on Meta. This optimism seems almost counterintuitive given the lack of cloud revenue we just discussed. What exactly is driving this high conviction from the analysts?
Morningstar's conviction really stems from the fact that Meta's AI investments are generating immediate, measurable leverage in their core advertising business. It's not a hypothetical future payoff.
It's happening now.
Yes. Meta's Advantage Plus suite, which is their automated ad platform, just hit a $20 billion annual run rate.
$20 billion.
Yeah. Advantage Plus essentially acts as a black box for advertisers. Instead of human marketers manually tweaking demographics and targeting parameters, they hand their budget and creative assets directly to Meta's AI.
And the AI takes over.
Completely. The algorithm tests thousands of permutations in real time to find the absolute optimal audience.
And the data shows it is working. The Morningstar report notes that Advantage Plus is giving advertisers a 22% average lift in return on ad spend.
That's huge.
It is. When an advertiser sees a 22% improvement in the revenue generated from their ad budget, their immediate reaction is to allocate more budget to Meta.
Naturally.
Because the algorithm is making the delivery so much more efficient, ad impressions overall were up 18% for the quarter.
It creates this beautiful self-reinforcing cycle of profitability for them. And Meta is simultaneously expanding the surface area where those highly optimized ads can live.
Like WhatsApp.
Exactly. They are finally activating monetization on WhatsApp. With 3 billion monthly active users globally, WhatsApp has historically been a vastly undermonetized asset.
Right.
By injecting ads into the Updates tab, they are opening a massive new channel for revenue without fundamentally disrupting the core messaging experience.
But the advertising optimization only tells half the story. The really compelling aspect of Meta's transformation is the sheer physical infrastructure flex they are executing right now.
It's unbelievable.
They aren't just procuring servers, they are operating at an industrial scale that rivals sovereign nations.
To contextualize the scale we are talking about, consider that a typical large-scale enterprise data center might draw anywhere from 50 to 100 megawatts of power.
Okay, 50 to 100 megawatts.
Meta is currently building 5-gigawatt Hyperion computing clusters.
5 gigawatts.
That is an unprecedented power requirement.
Yeah.
And to guarantee the uninterrupted energy required to train next-generation foundational models, Meta is signing multi-billion-dollar agreements with nuclear energy providers.
They're literally securing their own energy grid.
Yes, to ensure their proprietary Prometheus infrastructure never experiences downtime.
That level of capital commitment is staggering. They are pairing that nuclear energy strategy with their own custom silicon, the Meta Training and Inference Accelerator, or MTIA.
Yep.
And they also just committed a $10 billion investment into the data labeling startup Scale AI. That specific investment is designed to feed flawlessly annotated data into their upcoming Llama 4 model.
Which is critical. In the AI space, the quality of your training data dictates the reliability of your model. It reduces hallucinations and makes the output truly enterprise-grade.
So they are meticulously controlling every layer of the stack.
Every single layer. The power generation, the custom silicon, the data pipelines, and the foundational models themselves. This level of vertical execution is precisely why Morningstar has issued such aggressive valuation targets.
Right, because with Meta's last close price sitting around $668, Morningstar has established a fair value estimate of $850 per share.
It's a massive premium.
They are projecting a robust 25% sales growth for Meta in 2026, driven entirely by the AI enhancements to the ad business.
Exactly.
So what does this all mean? Anytime analysts project a fair value estimate that is nearly $200 higher than the current trading price, it means the broader market is pricing in significant risks that the analysts believe are overstated. What are the specific headwinds keeping Meta's stock price compressed at $668?
This raises an important question about resource allocation. With Meta, the primary risks are substantial and frankly, very transparent. First, we have to look at Reality Labs, their metaverse and spatial computing division.
Ah, right, the
That
metaverse.
division is still absorbing $16 billion a year in operating
The
losses.
16 billion.
While Mark Zuckerberg views this as a long-term strategic necessity for the next computing platform, Wall Street generally views it as a severe anger, dragging down their overall profitability.
There's also the macro regulatory environment to consider here. Meta is facing a looming U.S. antitrust monopoly case. Now, just to be clear for you listening, analyzing this purely from a market mechanics perspective, we take no stance on the underlying legal merits or the political landscape surrounding the case, but it functions as a major headline risk.
Absolutely. Institutional investors loathe regulatory uncertainty.
They do.
Until that case is resolved one way or another, it will act as a psychological ceiling on the stock.
Furthermore, despite the billions poured into developing their consumer-facing Llama chatbots and open sourcing those models to developers, Meta still lacks a clear, direct monetization plan for the models themselves.
Right. Open sourcing builds a phenomenal developer ecosystem. It commoditizes the models of their competitors. But how a conversational chatbot directly adds billions to Meta's bottom line remains an unanswered question for shareholders.
And we should be fair here, Amazon is not operating without risk either. The entire bull thesis for Amazon rests on AWS maintaining its growth trajectory.
That's the linchpin.
If AWS growth decelerates from 20% back to the 13 to 15% range we saw during the post-pandemic optimization cycle, that $125 billion capital expenditure suddenly looks much less like a brilliant double monetization strategy.
It starts to look far more like a bloated liability.
Exactly.
That is a critical vulnerability,
Right.
and it ties directly into the broader 2026 macroeconomic landscape that LPL Financials outlined in their market commentary. We have to look at market breadth.
The Magnificent Seven.
Right. The Magnificent Seven, which prominently features both Amazon and Meta, has been responsible for driving over half of the entire S&P 500's earnings growth over the past several quarters. It has been an incredibly concentrated rally.
But LPL Financial expects that concentration to shift. They're forecasting that the wide earnings gap between these tech giants and the rest of the market will begin to narrow as 2026 progresses.
Which changes the whole dynamic.
It does. If market breadth weakens, or if the initial wave of AI enthusiasm begins to cool down into a more sober assessment of return on investment, we could see a harsh rotation away from these tech premiums and into traditional value stocks.
Yeah, if the broader market decides that AI infrastructure spending has become a runaway train, these trillion-dollar valuations will face severe testing.
It is the classic vulnerability of priced imperfection. When a stock is priced for flawless execution, any slight deviation in guidance can trigger a disproportionate sell-off.
Absolutely.
Let's bring this all together for you to recap the core parameters of this 2026 showdown. On one side of the ledger, Amazon offers the safety of structural diversification. They possess the double monetization advantage, leveraging AWS to fund their AI ambitions while optimizing a booming retail advertising network.
They are a self-funding, highly predictable growth engine.
Yes. On the other side, Meta represents an incredibly potent, high-margin advertising machine that is successfully utilizing AI today to drive measurable ROI for its clients. They are operating at an industrial scale, but lack the safety net of a public cloud, and are trading at a significant discount to Morningstar's fair value estimate due to regulatory and structural risks.
And as you weigh these two fundamentally different approaches to the AI revolution, I want to leave you with a final thought to mull over.
Let's hear it.
We consistently analyze Meta through the lens of social media and digital advertising.
Sure, because that's what they do.
But look closely at their quiet evolution over the past year. We discussed their 5-gigawatt clusters, the multi-billion-dollar nuclear power agreements, and their push into proprietary silicon with the upcoming 2-nanometer Santa Barbara MTIA version 4 chips.
Right.
The 2-nanometer architecture provides a massive leap in thermal efficiency and computing density.
They're basically building the physical foundation of the future.
Exactly. Consider the trajectory. What if Meta's ultimate endgame isn't simply about serving you a more highly targeted ad on an Instagram reel?
What else could it be?
With that unprecedented aggregation of compute power, proprietary silicon, and secured nuclear energy, what if by 2030, their strategy is to become a sovereign, physical utility provider for the global AI economy?
A utility provider.
If they control the energy grid and the custom hardware, they transcend being a participant in the AI revolution. They become the underlying utility powering it.
Wow. it fundamentally rewrites how we categorize the company, from selling digital attention to selling the raw physical power of the next computing era.
Changes everything.
It really does. Thank you for joining us on this deep dive. Whether you are actively managing a portfolio or simply watching the architecture of the future being built in real time, we encourage you to keep questioning the data, challenge the prevailing narratives, and always look beneath the surface of big tech's trillion-dollar bets. Until next time.